You know, usually when we talk about real estate booms, the tone is, well, it's pretty celebratory.
Yeah, it's all champagne corks,
Uh,
sold out launches, lines around the block.
Right. It feels like everyone is winning. But today, we're doing a deep dive into a source that argues all that noise isn't actually a sign of opportunity.
No, it's a warning.
Yeah, a massive warning. We're looking at a strategic manifesto called The Last Arbitrage. It's by Dr. Pooyan Ghamari, the founder and CEO of Aland FZE.
And honestly, this isn't your standard, dry market report.
Not at all. It reads more like a battle plan for the next 24 months.
Yeah, he's basically arguing that while everyone is fighting over the really flashy, obvious projects in Dubai right now, they're kind of just walking blindly into a margin trap.
A quiet, expensive trap. That's
Yeah.
how he phrases it, which is a great hook.
It is, because he's saying this current boom is structurally different from previous ones. If you just follow the herd, buy what everyone else is buying.
You're going to get squeezed.
Exactly. But if you know where to look, there's a massive structural advantage waiting. And he actually maps out 5 specific land corridors where this advantage still exists.
But he puts a really strict clock on it, right?
Yeah, a 24-month window. He calls it the confirmation cliff.
Right. So our mission for today's deep dive is to map out these 5 corridors for you, explain the exact financial and legal structures he recommends to capture them, and really unpack why 2026 is this hard, non-negotiable deadline.
Let's get into it.
So let's start with this idea of the trap, because looking at the macro data, record transactions, prices shooting up, it feels really counterintuitive to say it's a bad time to buy.
Well, he's not saying it's a bad time to sell. He's saying it's a very dangerous time to be a lazy developer.
Okay, unpack that a bit.
Dr. Pooyan identifies something he calls the European market fallacy.
Right.
A lot of international developers come to the UAE and they think it's just this open, free-for-all market, like London or New York.
Where you just find a plot of land, buy it, and build.
Right, exactly.
Yeah.
But that is fundamentally not how the UAE operates. It's built on a master developer architecture.
Meaning the big players.
The giants, Emaar, Nakheel, Aldar. They control the primary land pipeline. And here's the trap. When they finally release land to the secondary market, they aren't handing you a bargain.
They price it per sigma.
They price it at its future perfection value. They've already baked in the success of the community.
So if I'm a developer and I buy a primary plot from one of these master developers today, I'm basically paying a price that assumes my building is already finished, sold, and highly desirable.
Pretty much. The actual arbitrage.
The profit gap.
Right, that gap between what you pay for the dirt and what you sell the finished apartment for. That gap is razor thin because the master developer already ate all the margin.
Wow. So Dr. Pooyan is arguing that if you want real margins, you have to look exactly where the master developers aren't currently squeezing the price.
Exactly. You have to find the inefficiencies. But before we get to where those are, we have to understand the 2 massive macro engines driving this whole 24-month window.
Population and interest rates.
Right. The population data is just staggering. Dubai crossed 3.8 million people in 2024, and the government's official target is 5.8 million by 2040.
I have to admit, I always look at those 2040 master plans with a little bit of skepticism. Like, is that real growth or just a government wish list?
It's a fair question, but look at the actual migration patterns right now. This isn't just a projection.
The people are already arriving.
Yes. Between the Golden Visa program, which completely decoupled your residency from your employer, and the UAE's geopolitical neutrality, you have this massive, unprecedented influx of high net worth individuals.
And skilled workers too, right?
Absolutely. The airports are full today. It's happening now.
Okay, so massive demand side. What about the financing side?
This is the temporary window he's talking about. We've seen interest rates compress. They're about 180 to 220 basis points off their peak.
For the listeners who maybe aren't deep in corporate finance, what does a 200 basis point drop actually mean for a developer's reality?
It means money is on sale.
Literally.
Yeah. If you are financing a 100 million dirham construction project, that drop in rates saves you millions in straight interest payments. It significantly lowers your break-even point on the whole project.
But rates fluctuate.
They do. And that's his core point. You have relatively cheap money right now, and you have sky-high population demand right now. That creates a temporary window to lock in your cost base before things normalize.
Okay, so the setup is clear. We have heavy demand, cheaper money, but overpriced primary land. So the billion-dollar question, where is the underpriced land?
This is where we get to the 5 corridors.
Let's walk through them. Corridor 1 is a big one, Dubai South.
This is what he calls the infrastructure bet. We are talking about the Al Maktoum International Airport expansion.
The 128 billion dirham commitment.
Exactly.
But I feel like we've been hearing about this new airport in the south for a decade. Why is this time actually different?
Because the contracts are signed, and the concrete is actively pouring. It's no longer a vision on a PDF. This is going to be the world's largest airport, designed to handle 260 million passengers.
That scale is hard to even picture.
It's massive.
But here is the actual arbitrage. Land prices in Dubai South currently reflect only partial pricing.
Because the broader market is still skeptical.
Just like you were a second ago, people are still waiting to see it.
So the price hasn't baked in the completion yet.
Right. But in 36 months, when you could physically see the massive terminal structure rising on the skyline,
It's too late.
the prices will jump to their confirmed value. If you wait to buy then, you miss the margin. You have to buy the skepticism today.
But Dubai South is a huge geographic area. He breaks it down into specific zones, right? You can't just throw a dart at a map of the South.
No, you need absolute precision. Dr. Pooyan highlights the aviation district specifically for workforce residential housing.
Ah, for the staff. Think about it. Thousands of pilots, logistics managers, ground staff, they all need to live minutes from work. That's a very specific product type.
Well,
Then there's the residential district. This is for mid-market townhouses, targeting families who are just being completely priced out of central Dubai.
makes sense. And he mentions a golf district.
Yeah, that's the premium play, situated around the Trump International Golf Club.
Yeah.
But the underlying logic for all 3 zones is the same. You are front-running the inevitable shift of the city's center of gravity. It is moving south.
Let's pivot to Corridor 2. This one honestly surprised me when reading the source. Sharjah.
Yes.
Usually, when international capital talks about UAE real estate, Sharjah is an afterthought.
And that is exactly why it's on his list.
Yeah.
It's the ultimate margin story.
Mhm.
Because it lacks the loud glitz and headline volume of Dubai, the land there is 40 to 65% cheaper.
65% cheaper is just a massive discount. But is the final sales price high enough to actually make a profit?
That's the math he lays out, and it's compelling. If you go to a master plan like Tilal City in Sharjah and you build mid-market townhouses, you can generate 28 to 35% developer margins.
Just to compare, what is a typical developer margin in central Dubai right now?
If you execute perfectly, maybe 15%, 18% if you're lucky.
Wow.
The land cost in Dubai eats your profit. In Sharjah, the land creates the profit. Plus, you have 1.8 million residents already living there, mostly families and long-term expats who are completely exhausted by renting and want to buy.
He also mentions Sharjah waterfront city in this section. That sounds pretty ambitious.
It's very ambitious. It's a series of interconnected islands. Right now, there is a significant risk discount applied to the land there because it's not fully habitable yet. It still looks like a major construction site.
So it's hard for a buyer to visualize living there.
Exactly. But once the bridge is fully open and the first communities actually move in, that risk discount vanishes overnight. You are buying the uncertainty today to sell the certainty tomorrow.
Okay, Corridor 3, Ras Al Khaimah, or RAK. This whole corridor seems to be driven by one single massive catalyst.
The Wynn Resort.
The casino.
The Wynn effect is very real.
Yeah.
The introduction of an integrated gaming resort completely changes RAK's identity. It goes from being a regional weekend getaway for local staycations to an international tourist destination.
But Dr. Pooyan gives a pretty stern warning here about just blindly buying land near the casino, right?
He does. You can't just buy a plot near the resort and expect to print money. You have to understand the 2 very distinct types of buyers coming to RAK.
Okay, break those down.
First, you have the yield investor. They are looking at areas like Al Hamra Village. They want a small, efficient, 1 or 2 bedroom serviced apartment.
Something they can put on short-term rental platforms for the tourists and gamblers.
Exactly. Pure yield.
Yeah.
But the second buyer profile is completely different. The eco-luxury buyer.
Eco-luxury, so this is a different part of RAK.
Right, places like Mina Al Arab. This area is defined by mangroves, wetlands, untouched nature.
So you definitely can't just slap a generic concrete high-rise there.
If you build a concrete block in Mina Al Arab, it will not sell. It requires what he calls biophilic design, architecture that actually integrates with the natural environment. Low-rise, sustainable luxury.
There was also a really specific legal note for REK in the manifesto, something about entity structuring.
Yes, this is crucial if you're a foreign developer. You must use the Ras Al Khaimah Economic Zone, or RAKZ, to set up your corporate entity,
Why is that so important?
because it provides instant international legitimacy and very clean ownership rights. Dr. Pooyan warns that if you try to take shortcuts with a local structure and then try to retrofit it later when you want to attract international capital, it's a total nightmare.
Do it right from day one.
Exactly.
Moving on to Corridor 4, Abu Dhabi. Reading this section, it felt like a completely different sport compared to Dubai.
It is a different sport. He calls Abu Dhabi the institutional game. In Dubai, you can be a mid-size, agile developer, find a plot, and just go for it.
But not in Abu Dhabi.
No. The prime land in Abu Dhabi is tightly controlled, largely by Aldar. It's a massive moat. You don't just walk up to them and write a check for a plot of land.
So how do you even get a foothold there?
You have to bring value that goes beyond just capital. You need a joint venture strategy. You have to approach the master developer with a highly specific brand or a unique concept that they can't easily execute themselves.
Give me an example of what that looks like.
Think about Saadiyat Island. That is the cultural district.
Yeah.
You have the Louvre Abu Dhabi, the upcoming Guggenheim. The residential prices there are hitting 4,000 to 8,000 dirhams per square foot.
That is astronomical. That's comparable to top-tier real estate in London or New York.
It really is. But buyers are paying for a permanent scarcity premium. There is only one Louvre Abu Dhabi in the world.
Right.
So if you want to develop on Saadiyat, you need to bring a global luxury brand or an architectural concept that matches that extreme prestige. Generic luxury won't even get you a meeting.
And what about Yas Island? He mentions that too.
Yas is the experience economy. Ferrari World, the F1 track, that requires a totally different product. Mostly short-term rental and hospitality-focused developments to absorb the tourism demand.
Fascinating. All right, Corridor 5. He calls this one the hidden arbitrage. Secondary land in master communities.
This is for the real detectives out there.
Yeah.
We're talking about very established, highly desirable areas. Places like Dubai Creek Harbor, Dubai Hills, or Mohammed bin Rashid City.
Where the master developers sold out all their primary plots years ago.
Exactly. But if you look closely, there are private investors, wealthy families, individuals who bought premium plots back in 2018 or 2019, and they've just sat on them.
So you have these empty dirt plots completely surrounded by finished, thriving communities.
Yes. And these private owners are often stuck.
Stuck how?
Well, they aren't developers. They don't have the team or the expertise to actually build a tower, but they don't want to sell the land outright because they'd get hit with transfer fees, or they strongly believe the land value will keep going up.
So how do you, as a developer, unlock that land if they won't sell?
You don't buy it. You partner with them. You create a joint venture.
And that transitions us perfectly into segment 3 of the source material. Structural frameworks, this is the how. And this concept of a zero capital acquisition model seems to be the absolute holy grail that Dr. Pooyan is advocating for here.
It is. It's brilliant.
Walk us through how that actually works in practice.
It's a framework to push your return on capital to infinity, theoretically. In this joint venture model, the private landowner contributes the plot of land to the project.
Okay.
You get that land officially valued by RICS, that's the Royal Institution of Chartered Surveyors, so there's an objective third-party price. Nobody's arguing about what the dirt is worth.
So that agreed land value becomes the owner's equity stake in the project.
Exactly.
Meaning the developer puts in literally zero cash upfront for the land.
Zero capital for land acquisition. The developer instead contributes the sweat equity, the execution, the branding, the construction management, the sales and marketing.
Okay, so how does the money flow once the project starts selling?
The developer takes a management fee right off the top of the revenue, usually 3 to 5%.
Just to keep the lights on and cover operational overhead.
Right. And then, at the end of the project, you split the final net profit. Typically, it lands around 50 to 60% for the developer and 40 to 50% for the landowner.
It makes perfect sense. The landowner finally gets their dormant land unlocked and monetized without having to learn how to build a skyscraper.
And the developer gets a prime project without sinking tens of millions of dollars into buying dirt. It drastically reduces the developer's upfront risk.
Speaking of managing risk, Dr. Pooyan emphasizes this concept of a clean entity architecture. He says every single project needs its own SPV.
A special purpose vehicle, yes. This is non-negotiable for him.
Why is that so critical? A lot of developers just run everything through one main company, right?
They do, and it's dangerous. There are two huge reasons for an SPV. First is basic asset protection. If one specific tower runs into severe delays or a legal issue,
It doesn't drag down your entire corporate portfolio.
exactly, it completely prevents financial contagion.
And the second reason.
Exit optionality. This is the smart play. If you own a project cleanly inside its own standalone SPV, you can actually sell the entire company halfway through the development cycle.
Wow. Okay.
You sell the shares of the SPV. And with those shares goes the land, the permits, the escrow account, the pre-sales, everything. You hand over the keys. You cannot do that if the project's accounting is all tangled up in your main company's books.
He also mentions phased acquisition as a risk tool.
Yes. This is the don't bet the farm rule. If you were going the traditional route and actually buying a massive master plan site, do not buy the whole thing at once.
Buy a piece of it.
Buy 30 or 40%, launch phase one, sell it. Then use the revenue generated from those phase one pre-sales to fund the acquisition of the land for phase two.
You're using the market's own momentum and capital to expand rather than heavily leveraging your own balance sheet.
He calls it intelligent risk architecture. You minimize your financial exposure at the very beginning when your market information is at its lowest.
Okay, so even if a developer finds the perfect corridor, uses zero capital JVs, and sets up clean SPVs, Dr. Pooyan says they still frequently fail because of the buyer definition error.
This is probably the most common painful mistake. He notes that developers routinely bleed 20 to 35% of their potential margin right here.
Just by designing for the wrong person?
Exactly. They build the beautiful building that they want to build instead of what the specific buyer in that specific corridor actually needs.
He outlines 4 distinct buyer profiles in the text. Let's run through them. We have the end user versus the yield investor.
Totally different animals.
Right.
The end user is making an emotional purchase. They care about livability, kitchen size, proximity to good schools, the feeling of the community. This is your target buyer for Sharjah or the residential district in Dubai South.
And the yield investor.
The yield investor is basically a spreadsheet with a pulse.
That's a great way to put it.
They don't care about the kitchen finishes.
Yeah.
They want cold, hard cash flow. They want small, hyper-efficient units, 400 to 750 square feet. And they want full property management included, so they never have to deal with a tenant.
So if you go to a high-yield area, like the workforce zones, and you build a massive, sprawling 3-bedroom villa,
You've completely failed. The yield investor won't touch it. They can't rent it out easily. The service charges eat their returns. The yield is terrible. You have to match the physical product to the financial profile of the buyer.
then you have the capital appreciation investor and the lifestyle buyer.
Right. The capital appreciation buyer is buying a story. They are the ones buying into the skepticism of Dubai South or the unbuilt islands of Sharjah waterfront. They are betting on the infrastructure.
And the lifestyle buyer.
The lifestyle buyer is highly price insensitive. They are buying a badge, an identity.
The Saadiyat Island buyer.
Exactly. They want to drop at a dinner party. Oh, I have a place next to the Louvre. They aren't running an ROI calculation. They are paying for status and experience.
So the rule is, define your buyer before you finalize your land. It sounds so fundamental, but I guess when the market is booming, people just forget the basics.
When everything is selling, people get lazy. That is the essence of the margin trap.
Which brings us to the when. Why is this entire deep dive titled The Last Arbitrage? Why is there a strict 24-month deadline on all of this?
This is that confirmation cliff we touched on at the start. Just think about the physical construction timeline. By late 2026, the Al Maktoum Airport Terminal will be visibly rising out of the ground.
Right.
The Wynn Casino in RAK opens in 2027, which means by late 2026, it will be nearing completion. The bridges to the Sharjah Islands will be finished.
So all the secrets will be out in the open.
Exactly. Real estate markets rapidly reprice certainty. Once a retail buyer can physically see the airport terminal, the surrounding land prices will instantly jump to reflect that new reality.
The window closes.
The arbitrage, the outsized profit, is simply the gap between today's doubt and tomorrow's certainty.
So if you sit on your hands and wait until you feel entirely comfortable with the market,
You are paying the retail price. Comfort is very expensive. Dr. Pooyan's entire thesis is that the structural advantage belongs to those who have the courage and the data to act before the physical confirmation is staring everyone in the face.
it really reframes the way you have to look at the market. It stops being a question of, hey, is Dubai booming? And becomes, where exactly is the inefficiency today?
Precisely. It's about structural precision. It's about meticulously matching the right land corridor with the exact right buyer profile inside the correct legal SPV.
It's the architecture beneath the market. I love that phrasing from the source.
That's where the real money is made. not in the headlines.
So here is our final provocation for you to mull over as we wrap up. When you look at your own strategy, whether you are actively developing, deploying capital as an investor, or just watching the market play out, are you chasing the loud noise of what just sold out yesterday? Or are you hunting for those quiet, unconfirmed opportunities that are going to be the front page headlines in 2026? Are you paying for comfort, or are you getting paid for foresight?
That is the question that decides who wins the next decade.
Thanks for joining us on this deep dive into the last arbitrage. We'll catch you on the next one.